Today we're going to talk about life insurance and long-term care insurance. These are the two types of policies that affect every single living person that's out there. So I hope you get a little value out of this and you can see how those types of policies might help you and impact your life. Good day, my name is David Fusco, and in this show I'm going to talk about business, finance, and how to survive and thrive in this crazy environment that we're living in today. Welcome to my show. Good day. Today is January 21, 2025, and we're into the new year, almost nearing the end of the first month. And my name is David Fusco. I'm a certified public accountant. Today I'm here with Andrew Cilento. He's a certified financial planner. And we're here to talk about today insurance and why you might need it and what insurance is. We're not going to get into every type of insurance, but we're going to talk about the ones that pretty much everyone should have or may need to have. So I'd like to introduce Andrew, and so if you want to tell us a little bit about yourself, that would be great.
Well, first, thanks for having me, Dave. I'm a certified financial planner located here in Staten Island, and we help our clients with a lot of different aspects of their financial plan and their financial life. I came into the business because this is something I've always been passionate about, and I graduated from NYU and worked at an asset management firm for 5 years, but financial planning is something that I've always been around because my dad was in the business for 40 years. So that's kind of what drew me into this side of the business and how we could get to help individual people and help our clients. So thanks again for having me here today.
And actually, just to say something, I knew your father for all those 40 years.
Yeah, yes, you
met
did.
him way back in the 1980s when I had hair on my head.
You still look good, though.
Oh, thank you. So, a lot of times I hear from my clients that, or they may not even know they need insurance, but let's say they do know they need insurance, and they'll say, oh, I need life insurance. And that's a pretty common one. And, so for example, why would somebody need a life insurance is, I guess, the first question that someone might want to hear. And they might say, hey, I'm only 22 years old, 25 years old, I have no family, I have nobody that I'm responsible for, so why should I even have it? So I'd like to hear your thoughts on why somebody might need insurance, what are the different things that you should consider, and let's talk about that first.
Yeah, so there's a lot of different use cases for insurance. Primarily, it's to provide a death benefit for a family member or somebody you would like to leave money to. So it's very important when you have young dependents. It's also very important if you just got married and you bought a house with a spouse, because generally, most of the time, when you buy a house with somebody, it's both of your incomes collectively. So if something were to happen to one of the people, you want to make sure that your spouse is going to be able to afford the mortgage and stay in the home and not have to sell it, God forbid something were to happen. Same type of deal with having young kids. You want to make sure that you can still live that lifestyle that you wanted, pay for college, do all those types of things. Life insurance is important to get when you're young and you're healthy, because as you get older, more things happen. You may not be insurable, you may be insurable at a worse rating. So it is very important to get when you are healthy, and that's why some people do like to get it before they are married and before they have kids, because they know it's something that they're going to need eventually. And the other part of it is there's two different types of insurances. So there's term insurance and permanent insurance. Permanent insurance can build wealth while you're living, and it's something you can utilize as retirement income. Some policies also have benefits on them that you can use for long-term care or critical illness as well, which means, God forbid, you had a cancer or a heart attack or a stroke, you'd be able to utilize the death benefit while you were alive. So there's a lot of different things you can do with it.
Okay. What are the factors that go into the cost of an insurance policy to someone?
So it starts with your age and your health. The insurance companies, they have teams of underwriters that look into you. So they'll look at your medical history, see if you're on any types of medication, again, see your family history, see how that is associated with maybe you had a parent that passed away earlier in life. So there's a lot of different factors that they look at.
Yeah. Actually, since you mentioned that, I have a client, and this happened fairly recently, who took out an insurance policy through you, and about 3 months later, he had a significant heart attack. And the insurance company looked into that, thinking, was this in his records? Did he deserve the insurance at the rate he was given? And it was a pretty big policy. I think it was like for a few $1,000,000, $5 million, I think. And he ended up getting paid $1 million, and that came to him tax free. And that obviously is very helpful to the guy. So I understand. And once he had that heart attack, what would have happened? Would he have even been able to get insurance?
Oh yeah, certainly. After something like that, you're uninsurable. So some carriers that we work with provide living benefits, like what Dave just discussed. So we never want anything like that to happen to our clients, but it's good to know that there are some companies out there that offer other benefits, just other than if you were to just pass away.
So now, you talked about a little bit about permanent insurance and term insurance. Can you describe first what term insurance means?
So term insurance is insurance for a specific amount of time. Generally, they are 10 years, 20 years, 30 years. So what that means is that if you are 40 years old and you take out a 20-year term, you are covered for the next 20 years. So God forbid you were to pass away in that time horizon, your family or whoever you list as your beneficiary would get a tax-free lump sum of money, which is the death benefit. So it's very good for people whose cash flows may not be able to support a permanent policy, or if a permanent policy may not be necessary for everybody. It gives a lot of people peace of mind. They know that they could go to sleep at night knowing that their family would be taken care of, God forbid something were to happen to them. So that's where term insurance comes into play.
And what happens at the end of that term?
So at the end of the term, you kind of have options. If you don't do anything, the term expires, and a lot of the times people ask, well, if I have a 20-year term and I'm 40, what happens when I'm 60? If you wanted to get more insurance, say you still have a mortgage or your family still needs some protection, your new policy would be based on your current health. So what we tell our clients is you don't know what's going to happen when you're 60. You don't know if you're even going to be able to get insurance. Life, there's a lot of uncertainties. So the term insurance is also good because you lock in your current health rating when you get it. And you're able to convert term policies up until a certain point. So if you have a 20-year term, you may have 15 years where you can convert some of that to be a permanent policy. So term insurance locks in your health rating, which is a very big part of it.
Okay. And now, as far as like the permanent insurance, I know there's different types of permanent insurance. So I guess the standard one that is in the industry is whole life.
Mm-hmm.
And what does that mean?
So whole life insurance is a permanent type of insurance that has a death benefit, but it also has a cash value account that accumulates. Whole life grows at a guaranteed rate, and the investments are invested in the insurance company's general account. So they grow very conservatively, and it's like investing in treasury bonds or treasury bills. So it's nice, slow, and steady. You pay your premiums, your death benefit is guaranteed, and the cash value is guaranteed by the insurance company. So it's a very good tool to use as part of the financial plan. Number one, primarily for people who want to have a death benefit forever, if they want to leave money to their children. Having a permanent policy allows you to have money set aside that will go to them, and when you go to retire, it gives you a little bit more freedom and flexibility to spend down your assets, knowing that there is money that will go to your children or who you want to leave it to for legacy planning.
I see. And besides the whole life policy, what other permanent insurance policy types are there?
There's something called universal life and variable universal life, and these policies are not guaranteed. They have a little bit more flexibility with them. A universal life policy, its cash value grows at a current interest rate, so it's dependent on the interest rate environment. The premiums that you pay there are a little bit more flexible than whole life, so depending on some people's cash flows, it may make some more sense. And then there's also variable universal life, which the cash value is invested into sub-accounts, and you can be invested into different funds, and those values fluctuate depending on the fund's performance. So it really comes down to somebody's risk tolerance and what they're looking to accomplish. Our approach is that insurance should be your safety net. So we like insurance products on the whole life side that has some guarantees, or indexed universal life, because you are protected to an extent, but every situation is different and everybody has different philosophies on it.
Now, I've also heard about riders on insurance policies. What is a rider? What does that mean?
So riders are supplemental things that you can add to the insurance policy. Like we just discussed before, Dave's client had a critical illness rider on the policy, and some companies have these for no additional charge. And what they do is they provide you with additional benefits. So a critical illness rider is something that would allow you to use the death benefit while you were living if you had something like a heart attack or a stroke or cancer and you survived it, like your client. There's some other riders like waiver of premium, which we really like, because God forbid you were to get disabled, the insurance company will continue to pay your premiums for you. So we have some clients that unfortunately were disabled. They're unable to work anymore, but the insurance companies continue to pay their premiums, so their policy is staying in force.
I'm a tax man, so predominantly, somebody dies, the beneficiary receives the money. Is that taxable to the person?
No, the death benefit is paid tax-free to the beneficiary. So that's one of the great parts of the life insurance.
I see. Okay. And I know there's all types of insurances. We're here just talking about the ones a little bit that affect most people. So we talked about life insurance just now, and I think another one that's pretty up there in a lot of people's minds, especially as they age. They hit more so. I notice people think about it when they're in their 70s. They go, "Hey, wow, I've got assets that I accumulated all my life long, and I'd like to protect those assets that I have and not lose them, just in case, I end up in a nursing home or in a situation like that." So what kind of a policy would somebody get to protect their assets? And in general, how does it work? And when do you think is the best time to buy that kind of policy?
So there's some policies that have a chronic illness rider on them, and that covers people, God forbid, that they couldn't do 2 of the 6 activities of daily living. Mm-hmm. So it's very similar to long-term care. Mm-hmm. So there are some policies that provide that at no additional cost, and it's a great benefit to have on the policies, because long-term care insurance is extremely expensive.
So what you're talking about is actually a part of the life insurance policy?
Yeah, it could be a rider attached to the policy, or there's some life insurance policies that are hybrid policies, which means it's life insurance and it's also long-term care. So there's a lot of flexibility, and depending on the client's needs, it's good that there are additional ways to get long-term care insurance rather than strict traditional long-term care, because a regular long-term care policy, you pay your premiums, and if you don't use it, that money's gone, similar to auto insurance. Mm-hmm. And the insurance companies have the ability to raise the premiums over time for a certain class. So one way around that is what some people like to do, is they get a hybrid life insurance policy that has long-term care benefits associated with it, because your premiums are going to be constant, and that you have a benefit provided to you. And if you don't need it, and you don't go into a nursing home, or you don't need it, assisted living, or have somebody come take care of you, when you were to pass away, your beneficiary would get the death benefit. So some people look at that and they say, at least I know that my premium payments will be going to something eventually.
Right. On a long-term care policy, let's say you bought it on your own, what would trigger the policy, or what are some of the things that would trigger the person receiving the benefit for that?
So to trigger the benefit, you need to be unable to do 2 of the 6 activities of daily living for an extended amount of time, which is 90 days. And it has to be signed by a physician saying that you're unable to do those things. Activities of daily living would be going to the bathroom, dressing yourself, feeding yourself, getting out of bed. So
basically the stuff that we do
normal
every day.
people do every day.
Right,
So
got it.
2 of those 6 would qualify you for the benefit if you are unable to do them, and that's what would trigger a payment for the long-term care policies.
Got it, got
They also cover Alzheimer's and then serious cognitive impairment.
it. Right. So probably like a life insurance policy, if you're going to get that and you choose to get that, it's probably better to get it when you're young and healthy, or should you wait until you find out you've got diabetes?
Yeah, that's definitely a little bit too late. Long-term care is generally good to get upper 40s and 50s, and again, some policies have the benefit associated with them. So you could get a policy earlier on, like my own personal policy has a critical illness rider on it, and I know, God forbid, way down the line, if I were to have to go into a nursing home, my policy would be able to pay for some of those things.
Right.
So
One last question I want to ask you is, like, I've heard of there's 2 main types of agents. There's what's called a captive agent and an independent agent. And what's the difference between the two, and what are you?
So captive agents generally only work with one insurance company, so they may be limited as to what they could offer their clients. We're independent, so we are able to offer a wide variety of products that best suit our clients. So that's the two the 2 differences between them.
So effectively what it sounds like to me is, if you're a captive agent of XYZ company, you can only sell XYZ company's products, even if there's something better on the outside that they might use, and you're stuck to just selling their stuff.
Yeah, exactly. So that's the main difference between being captive and being independent. So
Got it.
being independent, it really helps us, and it's obviously what we're looking to do, because our clients are always at our best interest.
Got it. All right. Well, there's a lot to it, and I'm sure there's a lot more to it. So in order to get a better idea of what a particular individual needs, they would have to actually sit down with an insurance agent to discuss that, I'm assuming, and they would take different factors into computing what the person might need for coverage, along with that person's capability of making the premium payment on it. But that's something that needs to be done on a case-by-case basis, I'm sure.
Yeah, exactly. Everybody we sit down with, I'm sure you hear this a lot, everybody's situation when they come in for taxes is different.
Mm-hmm.
And we really have to sit down with our clients to understand their needs and what they're looking to accomplish, and that's how we're able to make some recommendations, whether it is only a term, whether it's a permanent policy, whether it's a blend of both. So every situation is unique.
Great. And I think we should throw in there, like, if somebody wanted to reach out to you in particular, how would they do that?
So you can reach out to us through our website, FJCFinancial.com, and you could also reach us via email and phone. It's all on the website, phone number, email, everything's there, FJCFinancial.com.
FJC.
Yes.
I got it, because sometimes when us New Yorkers talk fast, you can't understand it. Just want to make sure I got it right for myself too. So great, I appreciate it, and thank you very much. If you gain value out of this, I'd like you to give the video a like, and maybe put some comments in there, maybe put some questions in there. We'll monitor any questions that come in there, and we'll try to get back to you with an answer as soon as possible. So thank you very much.
Thanks for having me, Dave. Appreciate it. Thank you for your time.
Thank you. Thank you for watching today's podcast. Like and subscribe, and in the comments I would love for you to ask questions. We do our best to get back to answering your questions, and hope to give you more information about crazy topics in the world today.